Welcome to the Pro Ticker Deep Dive.
It is good to be back. And I really don't think there's a more interesting, more contradictory ticker on the market right now than the one we're diving into today.
I couldn't agree more. We are looking at a story that I think just perfectly captures the madness, the contradictions, the sheer speed of this AI market we're in. We're talking about a company that just posted numbers that, well, if you just glanced at the headline, you'd think it was a typo. We're talking about supermicrocomputer SMCI.
It's a fascinating case study. It really is. A study in extreme growth and the extreme pains that come along with it.
It really is. I want to just set the scene a little bit because the context here is everything. It is Wednesday, February 4, 2026. We're deep into what everyone's calling the implementation era of the AI boom.
Right. The hype phase is over.
Totally. The "this will change the world" PowerPoint phase is done. Now it's about pouring concrete, stringing power lines, and racking servers.
Yeah.
And right in the middle of all that is SMCI. They dropped their Q2 fiscal 2026 earnings yesterday, and the market's reaction has been, well, let's just call it schizophrenic.
That is a very polite way to put it. It's a Rorschach test for investors. What you see depends entirely on what you want to see.
Right. I mean, this is the hook, isn't it? It's a tale of two numbers. On one hand, you have revenue growth that is just shattering all expectations, exploding. And on the other, you have profitability metrics that have basically crumbled to historic lows.
It's like watching a sprinter break the world record while, simultaneously tripping over their own shoelaces at the finish line.
That's a perfect analogy. And yet, despite what some analysts are calling crumbling fundamentals on the profit side, the stock surged. Depending on when you look today, it was up anywhere from, 7 to 11%.
Which tells you something. It tells you the market, for now at least, is voting for growth, for market share over immediate profit. But there is a huge amount of tension under that price action. You can feel it.
Oh, yeah. The bulls are popping champagne over the volume, and the bears are just looking at those margins and sharpening their knives.
So that's our mission today.
That's our mission for this deep dive. We're going to unpack this Q2 report, but we're not just going to read off the spreadsheet. We need to get into the mechanics of this business. How can a company beat revenue by over $2 billion?
Yeah.
Which is just an insane number for a hardware beat.
It's unbelievable.
And still, at the same time, get a major bank like Goldman Sachs to slap a sell rating on them with a price target that suggests the stock should just fall off a cliff.
It's a paradox. There's no other word for it.
It is. And we need to answer that big question. Is SMCI a value trap, played by these governance ghosts and commoditization? Or is it maybe the most undervalued play in the entire AI hardware space because the market just doesn't get their moat?
All right. Let's get into the machinery.
Okay, let's start with those headline numbers because we just have to address the sheer scale of what happened here. I look at this top line number and I swear I had to refresh my terminal. Revenue for the quarter came in at $12.7 billion.
To be precise, $12.68 billion. But yeah,
Just to put that in context for everyone, the Wall Street consensus, the average of all the smartest people paid to follow this stock was around $10.42 billion.
So they didn't just beat, they beat by over $2 billion.
I really want to pause on that for a second. In the software world, you sometimes see these crazy beats because, distribution is digital. It costs nothing to send another million downloads.
Right.
But this is hardware. This is metal, silicon, coolant, huge server racks. To beat by $2 billion means you physically built, shipped, and installed a mountain of inventory that nobody thought you could move.
Exactly right. It implies a logistical velocity that is, frankly, hard to comprehend. And if you look at the growth rates, it gets even more staggering. That $12.7 billion represents a 123% increase year over year. But the number that really made my jaw drop was the sequential growth. Quarter over quarter, they're up 153%.
Wait, 153%?
In one quarter?
Yes. In 90 days, they more than doubled the size of their entire business, revenue-wise.
That is just... It's unbelievable speed. I mean, usually when a manufacturing company scales up, you see, 10%, 15% sequential growth, and you throw a party. How is it physically possible to ramp up that fast? Did they just find 10 new factories?
Well, it points to two big things. First, the demand. It's just voracious, almost price-insensitive demand for AI infrastructure. The hyperscalers are just screaming for hardware. But second, it speaks to a bottleneck clearing. You have to remember, in the last quarter, Q1, there was all this noise about delays.
Right, the Blackwell delays, the new NVIDIA chips.
Exactly. They had about $1.5 billion in shipments that were stuck in the backlog. They couldn't get them out the door because of component shortages and, customer site readiness.
So the floodgates just opened in Q2. The floodgates opened. So you had all the normal Q2 demand, plus this massive wave of delayed inventory from Q1 finally going out the door. The dam broke and the revenue flooded in.
And it wasn't just the top line, right? The bottom line, the earnings per share, also came in pretty hot.
That's right. The non-GAAP EPS was 0.069. The street was looking for 0.49 cents. And that's roughly a 40% surprise beat on the bottom line, too.
So on the surface, if you're a casual investor, just looking at the headlines, you say, grand slam, revenue beat, earnings beat, stock is up. What's the problem? But we're not casual investors here. We need to look at what they're actually selling.
Yeah.
Is this just like a generic server boom?
No, not at all. It is extremely concentrated. It is almost entirely driven by their AI GPU platforms. Those platforms now make up over 90% of the company's total revenue.
90%.
Yep. The old business, standard enterprise servers for databases and stuff, that's become a rounding error. They have effectively transformed the entire company into a specialized builder of AI factories. They are a pure play on the GPU market.
Which is fantastic when the GPU market is on fire like it is now.
It's the best place to be.
But it also means they have zero diversification. If that AI CapEx spend even slows down tomorrow, SMCI doesn't have a backup plan.
That is the big risk. They are leveraged completely to this one single trend.
Okay, so that revenue number is the shiny object. It's the magician waving his right hand. Now we have to look at the left hand. We need to talk about the butt, and it is a massive butt. Let's talk about the margin cliffs.
And this is where the story gets really complicated and, frankly, a little bit scary if you're a long-term bull. Because while that revenue chart is going parabolic, the gross margin chart just fell off a cliff.
Okay, let's look at the damage. What was the number?
Gross margin for Q2 fell to 6.4%.
6.4.
4%.
And to give you some context, just last quarter, it was 9.5%. And historically, if you go back a few years, SMCI always told investors to expect a range of 14 to 17%.
So we are operating at less than half of their historical target. I mean, 6.4% is razor thin. It feels like grocery store margins. I think some grocery stores probably have better margins, honestly. We are talking about the most advanced, high-tech AI hardware on the planet, and they're making pennies on the dollar for it.
In the hardware world, 6.4% gives you zero room for error, right? It means for every $100 of equipment they sell, they're only keeping $6.40 to cover everything else: R&D, sales, marketing, admin, and then maybe turn a profit.
The net margin is basically a rounding error at that point.
So why? Why is this happening? If demand is so unprecedented, like they keep saying in the press release, why can't they charge more? Basic economics says when demand is way bigger than supply, you get pricing power. SMCI seems to have negative pricing power here.
That is the multi-billion-dollar question. And there isn't one single answer. It's really a perfect storm of headwinds. But the first, and by far the biggest one, is customer concentration.
The whale.
The whale. In Q2, one single large data center customer accounted for approximately 63% of their total revenue.
Hold on, let me just process that. One customer was 63% of that $12.7 billion. That's what, like $8 billion from one entity?
Correct. Billions and billions of dollars from a single stream of purchase orders.
Okay, we don't have to be Sherlock Holmes here. Given the timing, the sheer volume, the talk about liquid cooling, the industry consensus is pretty clear. We're talking about XAI and that huge supercluster they're building in Memphis, right?
It's not officially confirmed by name in the filing, of course, but if you connect the dots, the scale, the timeline of the Colossus build-out, the public relationship between Elon Musk and Charles Liang, the CEO, it's the only logical conclusion.
So here's the problem with landing a whale that big. If I walk into a car dealership and buy one car, I'm paying sticker price. If I walk in and offer to buy the whole lot,
You basically own the dealership at that point. When a customer is that big, they have immense pricing power. They dictate the terms, they squeeze you. And SMCI, to keep that volume, to keep that customer from just going to Dell or HPE, they have to accept those lower margins. It's a golden handcuffs situation.
so it feels like they're just buying revenue. They're saying, we will take this deal, even if we barely break even, just to print that big number on the board.
That is part of the story, for sure. But there are other costs that are just eating into that margin, too. We talked about how fast this market is moving. To meet this demand, SMCI isn't putting these racks on boats.
Right.
They're not putting them on trains. They're putting heavy, heavy server racks on airplanes.
They're freight For servers.
Yes.
I mean, do you know how much a fully loaded, liquid-cooled server rack weighs? We're talking thousands of pounds. Putting that on a 747 has to be astronomically expensive.
It's the most expensive way to ship anything. But you have to think about the customer's math. If you're in an arms race with Google and OpenAI, every single day your new AI cluster isn't online is a day you're falling behind. The cost of delay is higher than the shipping cost, so they demand it.
But who foots the bill?
Well, it's usually a negotiation. But in this environment, to hit the delivery dates and win the contract, it looks like SMCI just absorbed a massive chunk of those expedited costs. And that comes directly out of your gross margin.
So they're flying heavy metal all over the world to keep their biggest customer happy. What else is hitting them?
Component volatility is another one. There have been ongoing shortages in memory, particularly high bandwidth memory, HBM, and also in storage. And the pricing is all over the place. So if you quoted a price to a customer 3 months ago based on memory costing X, but the spot price spikes to Y right before you build it,
Your margin gets squeezed.
it gets squeezed. And you can't always pass that on if you have a fixed price contract. And on top of all that, management also explicitly mentioned tariffs as a drag.
So management knows the 6.4% number looks bad. They have to. What's the rebuttal? How is the CEO, Charles Liang, spinning this?
Charles is playing the long game. At least that's the story he's telling. His stance is that this is a land grab. They are purposely, consciously sacrificing short-term margin for market share dominance and to get new customers, what they call new logos.
It's the Amazon strategy. Your margin is my opportunity.
In a way, yes. The argument is, let's get the footprint. Let's become the incumbent vendor. Once we are installed in these massive data centers, we can start to upsell services, we can optimize our supply chains, and the margins will recover over time. They did guide that margins should improve by about 30 basis points in Q3.
30 basis points, that's 0.3%. So they go from 6.4% to 6.7%. I mean, that's hardly a recovery. That's a rounding error.
It's not a big jump, you're right, but it's a signal. It signals that the bleeding has stopped. They're trying to project stability, not necessarily a V-shaped recovery.
Okay, so the whole argument is we'll capture the market now and figure out how to monetize it later. But how do you do that? How do you turn a commodity hardware box into a high-margin business? If you're just assembling parts from NVIDIA and Intel, aren't you just a glorified screwdriver shop at the end of the day?
And that right there is the entire bear case. But the bull case, it relies on something else. This brings us to Section 3, the secret sauce. Or at least what SMCI claims is their secret sauce, their moat.
Right. We are talking about the DCBBS.
DCBBS, Data Center Building Block Solutions.
It's a catchy acronym. But what is it really?
It's their big strategic pivot. It's their attempt to move from just selling a box to selling the entire ecosystem. It's about selling a plug-and-play data center.
So what does that include? It's more than just the server.
Much more. It's the server, yes. But it's also the coolant distribution units, the CDUs. It's the manifolds, the plumbing, the software that manages it all, the on-site installation services. It is the whole package, soup to nuts.
And the crown jewel of this whole strategy, the thing that supposedly sets them apart from a Dell or an HP, is their lead in liquid cooling.
Absolutely. This is where they claim to have a huge first-mover advantage. Depending on who you ask, they've captured anywhere from 30% to maybe as high as 70 or 80% of the liquid cooling market for these huge AI clusters.
I want to dig into this because I think a lot of people just hear liquid cooling and think it's a buzzword.
Right.
Why does it matter so much? Why can't we just use bigger fans like we have for the last 30 years?
Physics. It really just comes down to physics. A thermal density problem. The new chips coming out, the NVIDIA Blackwells, the future Rubin chips, they are incredibly power hungry. A single rack of these new servers can pull 120 kilowatts of power, maybe even more.
120 kilowatts. A traditional server rack is, what, 10 or 15 kilowatts?
Exactly. You're cramming 10 times the power and heat into the same physical footprint. If you try to cool that with just air, with fans blowing over heat sinks, you physically cannot move enough air fast enough to get the heat out. The chips would just throttle down or melt.
So it's not a luxury feature anymore, it's a requirement. If you want to use the fastest chips, you have to have liquid cooling.
It's non-negotiable. And this is where SMCI's direct-to-chip blind mate boiling system comes in.
Okay, you've got to unpack that name for me. Blind mate boiling system. It sounds a little hazardous.
It does, doesn't it? Let's break it down. Direct-to-chip just means the cold plate sits right on top of the GPU. Boiling refers to two-phase cooling. The liquid comes in, it absorbs so much heat that it actually boils and turns into a gas inside the loop. That phase change absorbs a massive amount of energy.
And the blind mate part, what's that?
That's the operational magic. In a traditional liquid setup, if you have to swap out a server, you're manually unscrewing hoses, you're worried about leaks, it's a mess. Blind mate means the fluid connectors are built into the back of the chassis. You just slide the server into the rack like a drawer, and it automatically clicks into the manifold. No hoses to touch.
So it connects the plumbing for you
No.
automatically.
Exactly. It makes maintenance way faster and dramatically reduces the risk of leaks, which is a huge deal in a data center.
So what are the hard numbers here? Why does a CFO at a hyperscaler care about this?
Two things: efficiency and speed. SMCI claims this system can reduce power and water consumption by up to 40%. When you're running a gigawatt-scale data center, a 40% savings on your power bill is, well, it's tens of millions of dollars a year.
And the time to online. The speed.
That is the killer app. Because SMCI pre-integrates all of this at their factory, they can ship a rack that is basically ready to turn on. Their competitors might ship you the servers, and then you have to hire a third-party contractor to come in and plumb the whole data center, which can take months. SMCI is selling speed.
In this AI arms race, speed is the only currency that matters.
That's it. And the long-term hope for them is that this DCBBS ecosystem is sticky. Once you install their proprietary plumbing, their manifolds, their software, you can't just easily switch to a Dell server next year. You're locked in.
So is this DCBBS stuff actually making them money yet? Or is it just a fancy loss leader to sell the low-margin boxes?
It is profitable and supposedly at a much higher margin. Management said on the call that DCBBS contributed about 4% to profits in the first half of the year. The goal, and this is what investors really need to watch, is they expect that to double into the double digits by the end of calendar 2026.
So the thesis is, take the margin pain on the hardware today to get our plumbing installed. Then we make the real money on the services and proprietary cooling tech for the next 5 years.
That is the path out of the 6% margin trap. High margin, recurring service revenue.
Okay, I see the path. It's a viable strategy if they can execute. But execution requires trust. And we cannot have an honest conversation about SMCI without talking about the big, dark cloud that has been hanging over this company. We have to talk about the governance ghost.
The trust deficit. It's real.
It's the elephant in the room, and it's not a small elephant. The back half of 2024 and pretty much all of 2025 were turbulent, to say the least.
That's putting it very mildly. It was a corporate near-death experience.
Let's run through the timeline, because I think people forget just how bad things got. And this wasn't their first rodeo with accounting issues, right?
No, it's not. You have to remember, they were actually delisted from the NASDAQ back in 2018 for failing to file financial reports for 2 years. They had all these issues with recognizing revenue too early. They eventually settled with the SEC and got relisted in 2020.
So there's a history here,
Yeah,
a rap sheet.
there is a history. Fast forward to late 2024. A big short seller report comes out, alleging that some of the old bad habits were back.
And then the auditor walked out.
That was the hammer blow. Ernst & Young, one of the big four global auditors, resigned right in the middle of the audit.
And they didn't just resign quietly, did they? They wrote a letter.
A scathing letter. They basically said they could no longer rely on management's representations. In auditor speak, that is the equivalent of screaming fire in a crowded theater. It implies a total breakdown of trust and internal controls.
When your own accountant says, I don't believe anything you tell me, that's usually game over. The stock crashed. They were threatened with being delisted again.
Exactly. Then the subpoenas started flying. The DOJ, the SEC, it looked like the company might actually implode.
But here we are. It's February 2026. The stock is near all-time highs. They're filing earnings. What happened?
They survived. They appointed a special committee which predictably found no evidence of fraud, but admitted controls needed work.
The classic, we investigated ourselves and found we did nothing wrong.
Standard playbook. But crucially, they found a new auditor, BDO. And that was enough to satisfy the NASDAQ's listing requirements, so the immediate existential threat is gone.
But the scar tissue is still there.
Oh, it's thick. There's what's called a governance tax on the stock. Even if they put up great numbers, which they are on the revenue side, many investors will not pay a premium multiple for this company. They're just terrified that another shoe is going to drop.
Because the market hates uncertainty more than it hates bad news. With bad news, you can model it. With accounting fraud, the floor just vanishes.
Precisely. And that trust takes years and years to rebuild. You don't fix that kind of reputational damage in 2 quarters.
And yet, despite those ghosts, we are seeing some interesting institutional money starting to creep back in.
We are. The institutions fled in late 2024. But now you're seeing big names like Citadel and even Goldman Sachs' trading desk adding shares.
Which is the ultimate irony, right?
Ah,
Goldman's research analyst is screaming sell, but Goldman's trading desk is buying.
it suggests that the quants and the macro traders are looking at the growth, looking at the cheap valuation, and they're saying, you know what? The risk is priced in. This discount is just too deep to ignore. The greed is starting to outweigh the fear.
That brings us perfectly to the battleground. Section 5, the analyst civil war. Because Wall Street is completely split on this stock, you rarely see this much daylight between ratings.
It is remarkably polarized. You have very smart people looking at the exact same set of numbers and coming to completely opposite conclusions.
So let's start with the bears. Goldman Sachs. They have a sell rating target of what, $26? That implies they think the stock is going to get cut in half. What is their core argument?
Goldman's argument is all about the commoditization of hardware. They look at that 6.4% margin and they say, see, this proves our point. This is a race to the bottom. They argue that SMCI is just an assembler.
They don't believe in the moat.
They don't believe in the moat. They think if Dell or HP really wanted to, they could enter a price war and bleed SMCI dry because they have deeper pockets. They see this as profitless prosperity.
Okay, that's a compelling argument.
Yeah.
But then you flip the page and you see the bulls. Rosenblatt has a $50 target. Argus is at $64. That's massive upside. What are they seeing that Goldman is missing?
They are buying into the AI platform thesis. They argue that in this new era of liquid cooling, the server isn't a commodity anymore. It's a complex, integrated engineering challenge. They believe the DCBBS ecosystem is a real differentiator.
And they think the margin problem is temporary.
Exactly. A growing pain caused by the expedited shipping and the factory ramp. They believe once the new, cheaper factories in Malaysia come fully online, those margins will bounce right back up towards that 14% target.
And then there's the valuation argument.
Which is the strongest arrow in the bull's quiver. SMCI is trading at a forward PE of around 12 to 14 times earnings.
12 times earnings. For a company growing revenue at over 100%, in this market, a software company growing at 20% trades at 50 times earnings.
That's the dislocation. The bulls say the market is over-discounting the governance risk and the temporary margin hit. They're saying the Blackwell cycle and the upcoming Rubin cycle will drive so much volume that earnings will grow through sheer scale, even with lower margins.
So it really is a show-me story. The stock is just this battleground between people focused on revenue growth versus people focused on margin stability.
And people who can stomach the governance risk versus those who can't.
Okay, so what's next? Section 6, the road ahead. Management gave us some guidance, and they're talking some very big numbers.
They are. For the full fiscal year 2026, they raised their revenue guidance to at least $40 billion.
$40 billion. I mean, that puts them in the Fortune 100 conversation. That's a huge company.
It is. And for Q3, the current quarter, they're guiding for at least $12.3 billion. And you mentioned this earlier, the management team called that guidance conservative.
Right. They basically said supply constraints are the only thing holding them back. The demand is for a much higher number.
They are completely sold out.
Yeah.
But to fix that margin, they can't just sell more, they have to build it cheaper. And that's where the manufacturing expansion comes in.
This is key. They're moving out of Silicon Valley, right?
They are. Historically, their main factory is in San Jose, which is probably the most expensive place on earth to build anything. Now they are aggressively ramping up new, lower-cost facilities in Malaysia and Taiwan.
And that's where the real margin recovery could come from.
That's the operational fix. Shift the high-volume, standardized production to a low-cost region, and you keep San Jose for the high-touch, quick-turn R&D stuff. That blended margin naturally starts to drift upwards.
And they're not standing still on the tech side either. They're already talking about what comes after Blackwell.
Yep, they mentioned being ready for NVIDIA's next chip, the Vera Rubin platform, and also AMD's Helios later this year. They claim to be months ahead of competitors on these new designs.
That's always been their thing, right?
Yeah.
Speed, first mover advantage.
It's their lifeblood. They have to be faster than the big guys like Dell. But speed, as we're seeing, can be very expensive.
Okay, let's wrap this all up. It really feels like we're looking at a company with a split personality.
It's a total duality. On one side, you have an execution machine. They are delivering hardware at a scale and speed that is objectively incredible. They're building the plumbing for the entire AI revolution.
And on the other side, you have a company that is just operationally messy. The margins are crushed, the customer concentration is frankly terrifying, and the governance history is always lurking in the background.
It's the classic growing pains of a company that went from being a niche player to a global titan way too fast. They're building the plane while flying it at Mach 2.
So here's the final provocative thought I want to leave our listeners with. Is supermicrocomputer the canary in the coal mine for the entire AI boom?
That is the big fear, isn't it?
Think about it. Does their insane margin compression signal that the days of easy money in AI hardware are over? Does it mean the whales, the Microsofts, the Metas, the XAIs have gotten so powerful that they're just going to squeeze every last drop of profit out of their suppliers?
Are we shifting from the innovation phase to the brutal race to the bottom commoditization phase? It's possible.
Or is this just the messy, expensive scaling phase of a company that's destined to become the manufacturing backbone of the 21st century? Is this Amazon back in 2002 bleeding cash to build warehouses that will one day dominate global commerce?
That's the bull case in a nutshell, that this pain is them building their moat.
So the question for you, the listener, is, do you buy the liquid-cooled Titan at a discount and bet on the engineering, or do you fear the governance ghost and that margin cliff?
It's a high-stakes bet either way you slice it.
It certainly is. We will be watching G3 very, very closely to see if they can find those 30 basis points of margin.
I'll be watching the cash flow statement. Cash never lies.
Always watch the cash flow. That's a wrap for this deep dive into SMCI. Thanks for listening to the Pro Ticker Deep Dive.
See you next time.